It is Thursday, and silver is still holding firm around the $75 level, but the real moment of truth arrives tomorrow morning at 8:30 Eastern Time. Across global markets, traders, institutions, and algorithms are all locked in anticipation as the January non-farm payroll report approaches. For silver, the importance of this single data release cannot be overstated. Everything happening today is merely the prelude. The date is January 8th, 2026, and financial markets are balanced on a knife edge. We are moving through a period of index rebalancing, a mechanical process that often distorts price action and creates artificial weakness across asset classes. On this Thursday, major institutions and pension funds are adjusting allocations to match fresh annual mandates. This shift in capital is creating temporary pressure in markets that has nothing to do with underlying value. Silver is no exception. The uneven price movement and intraday volatility we are seeing today are classic signs of large-scale portfolio rotation taking place quietly beneath the surface. At the moment, silver is trading close to $75 per ounce, but it is being pushed and pulled by structural forces rather than fundamentals. These flows are technical in nature, driven by mandates and deadlines rather than conviction. Despite this pressure, the metal continues to defend its level with resilience. Market participants understand that this selling is transitory and that it masks the real tension building beneath the surface. Everyone knows that once tomorrow morning arrives, these artificial forces will fade and the true driver will take control. Tomorrow is Friday, January 9th, 2026, and at precisely 8:30 a.m. Eastern Standard Time, the Bureau of Labor Statistics will release the most influential economic report of the month. The non-farm payroll report has the power to reshape expectations across currencies, bonds, equities, and especially precious metals. For silver, this data point represents a binary event. The reaction could be explosive in either direction. Trading floors in New York and London appear calm on the surface, but behind the scenes, systems are being calibrated for millisecond reactions. Algorithms are primed to respond instantly the moment the numbers cross the wire. For anyone exposed to silver, understanding the dynamics of today is essential to surviving tomorrow. Index rebalancing often disguises true market sentiment, which at this moment is entirely focused on the Federal Reserve's next move. The Federal Reserve is data dependent, and no data set matters more right now than employment. The non-farm payroll report is the primary justification tool the Fed uses when deciding whether to loosen or maintain policy. Today, silver is holding the $75 line despite persistent pressure from rebalancing flows. That defense is notable. However, there is also a clear vulnerability. If tomorrow's data shocks expectations, support could fail, opening the door to a drop toward the $72 region. The dominant mood across markets today is caution. Nobody wants to be caught on the wrong side when the numbers hit. Silver occupies a unique position because it straddles two worlds. It is both an industrial input and a monetary asset. That dual identity causes it to react violently to shifts in rate expectations. Tomorrow matters because the Federal Reserve is actively searching for justification to cut rates at its upcoming meeting. Right now, the market is pricing in almost no chance of a cut. Expectations sit at roughly 4 basis points, effectively signaling hesitation. If tomorrow's jobs data comes in weaker than expected, that pricing will change rapidly. Traders would be forced to price in a more aggressive move, potentially a full quarter-point cut. That shift would act as powerful fuel for silver. On the other hand, strong data would reinforce the Fed's current stance and likely strengthen the dollar. This creates a high-stakes environment where silver could experience sharp moves within minutes. As Thursday progresses, traders are dissecting every forecast and whisper number. The consensus expectation sits in a narrow range that economists often describe as neutral. But history shows that non-farm payroll reports rarely land perfectly on consensus. Deviations are common and surprises are frequent. Late in 2025, silver surged more than 3% in a single session following a weak employment report. That event remains fresh in traders' memories. Many are positioning today with that possibility in mind. Fear of missing a breakout above $80 is colliding with fear of a breakdown towards $72 driven by mechanical selling. Volume today is lighter than normal. Large players are waiting. This reduced liquidity amplifies price swings caused by rebalancing, making today's action feel chaotic. On technical charts, silver appears compressed, forming a coiling pattern that often precedes a sharp expansion once a catalyst arrives. That catalyst is the December employment data. Every small movement in silver today reflects anxiety surrounding the health of the U.S. labor market. As the clock counts down to 8:30 tomorrow morning, everyone understands that the market landscape could look entirely different by midday. The stage is set, positions are loaded, and volatility is waiting. January 2026 is about to reveal its first defining moment. To understand why tomorrow carries so much weight, we need to break down the specific data points the market is watching and how those numbers translate directly into price movement for silver. The consensus forecast for the non-farm payroll report is currently calling for job growth in the range of 45,000 to 55,000 positions for the month of December. By historical standards, that is an extremely soft number and reflects a clear slowdown in the labor engine that once powered the U.S. economy forward. Beyond the headline job figure, attention is also locked onto the unemployment rate, which is expected to tick lower to 4.5%. That would represent a modest improvement from the 4.6% reading seen in November 2025, a figure that raised concerns across financial markets. These two numbers together form the core narrative that traders will interpret in real time when the report is released. The link between employment data and silver prices operates through what can be described as a yield reflection mechanism. Silver does not generate income. It pays no interest, no dividend, and no yield. Because of this, its value is highly sensitive to changes in interest rate expectations. When yields are elevated, investors prefer instruments that provide guaranteed returns, such as bonds or cash equivalents. When yields fall or are expected to decline, the relative attractiveness of silver increases sharply. This is why the exact number of jobs added matters so deeply. The employment report is immediately translated into a forecast for monetary policy. If labor conditions weaken, the Federal Reserve is pressured to ease. If labor conditions appear strong, the Fed can justify restraint. That translation happens almost instantaneously in modern markets. Goldman Sachs has highlighted a paradox shaping the economic landscape of 2026. While overall growth in the United States is running at a respectable 2.6% pace, job creation has stalled. This disconnect is being driven by federal workforce reductions and widespread efficiency gains, powered by artificial intelligence adoption across industries. The result is an economy that expands without meaningfully expanding employment. This dynamic creates an environment that feels unbalanced. Growth exists, but it does not flow through the labor market. For silver investors, this imbalance is constructive. The stagnant labor market pressures policymakers to remain accommodative, while ongoing growth supports industrial demand for silver in electronics, energy infrastructure, and solar manufacturing. This dual support is rare. Industrial consumption remains solid, while monetary conditions lean toward easing. Together, they form a favorable backdrop for silver prices over time. However, the market has not fully priced this in. Current expectations still reflect only a 4 basis point probability of a January rate cut, effectively dismissing the possibility. A weak jobs report tomorrow would force a rapid reassessment. Bond markets would begin pricing in a full 25 basis point cut, driving yields lower. That repricing would weaken the US dollar. Since silver is priced globally in dollars, a falling dollar mechanically lifts silver prices. The metal must rise in nominal terms to preserve purchasing power. There is, however, a clear risk scenario. If the payroll number exceeds 100,000 jobs, it would dismantle the stagnant labor narrative. Such a surprise would signal strength, giving the Federal Reserve justification to keep rates elevated. In that case, yields would rise, the dollar would strengthen, and silver would face heavy selling pressure. The algorithms that dominate short-term trading do not weigh long-term fundamentals when the data hits. They respond to deviation. The range between 45,000 and 55,000 jobs represents equilibrium. Results inside that band tend to mute reactions, but any print outside that range triggers an automated cascade of buying or selling that overwhelms order books within seconds. Another layer of complexity lies in revisions to prior months. These adjustments often receive less attention, but can significantly alter interpretation. Downward revisions would confirm ongoing weakness, even if the current headline meets expectations. That outcome would strengthen the bullish case for silver. Labor force participation is equally important. A declining unemployment rate driven by workers exiting the labor pool is not a sign of strength. Markets recognize the difference between job creation and workforce contraction. If unemployment falls for the wrong reasons, silver tends to respond positively as expectations shift toward policy easing. At its core, the market is weighing two opposing forces. Industrial resilience is pulling silver upward, while labor softness is pushing monetary policy toward accommodation. Tomorrow's data will determine which force dominates. At 8:30 a.m., the Bureau of Labor Statistics will provide clarity, and silver will adjust to reflect that verdict. As the final hours tick away before the release, investors must clearly understand the scenarios that could unfold once the clock strikes 8:30 tomorrow morning. There are 3 primary outcomes that matter, and each one carries a very different implication for silver. Preparation is not about prediction. It is about understanding reaction. The first outcome is the bullish scenario. This occurs if the non-farm payroll report shows fewer than 30,000 jobs added in December. A number this low would immediately raise recession fears across markets. Traders would rush to price in aggressive rate cuts from the Federal Reserve as a defensive response to economic slowdown. Bond yields would drop sharply as demand for safety explodes, and the US dollar would weaken rapidly. In that environment, silver becomes extremely attractive. It benefits simultaneously from falling yields, a weaker dollar, and rising demand for hard assets during uncertainty. A sub 30,000 print would likely ignite a powerful upside move, potentially sending silver quickly toward the $80 level. This is the type of data shock that creates vertical price movement, not gradual trends. The second outcome is the bearish scenario. This would involve a significant upside surprise, with job growth exceeding 100,000 positions. Such a result would directly contradict the current narrative of labor stagnation. Markets would interpret this as evidence that the economy remains strong enough to tolerate restrictive policy. In response, bond yields would rise as traders remove expectations for near-term rate cuts. The dollar would strengthen, and precious metals would face selling pressure. In this scenario, the index rebalancing pressure visible today would intensify rather than fade. Silver could be pushed down toward the $72 area, a key technical zone. The 71 to 72 region represents an important battlefield. Bulls must defend it to preserve the broader uptrend. A clean break below that level could trigger additional technical selling and stop losses, creating further downside momentum. The third outcome is the neutral scenario, often described as a Goldilocks result. This would place job growth between 45,000 and 60,000. In that case, the data would largely confirm existing expectations. Markets would likely react with short-term volatility, but no sustained directional move. Silver would continue to trade within its current range as investors wait for a clearer catalyst. Even under a neutral outcome, however, the broader environment still favors silver gradually. A stagnant labor market combined with steady economic output supports the metal over time. It may not produce fireworks immediately, but it maintains constructive pressure. There's also a psychological element to consider. Large financial institutions are aware that retail traders often react emotionally to the first move after major data releases. Initial price action can be deceptive. Sharp moves immediately following the release are sometimes engineered to fill institutional order books before the true direction emerges. A strong print could be used as an excuse to drive prices lower temporarily during the final stages of index rebalancing. This is why knee-jerk reactions should be viewed cautiously. Often, the first move is not the lasting move. For silver bulls, the ultimate objective remains a sustained break above $80. Reclaiming that level and holding it as support would mark a decisive shift in momentum. To achieve that, markets need to believe that a January rate cut is no longer optional but inevitable. At present, a 4 basis point cut probability is insufficient to support such a move. The market needs to reprice toward a full quarter-point reduction. Tomorrow's data will determine whether that probability jumps sharply or collapses entirely. Looking beyond the immediate reaction, the interplay between 2.6% economic growth and labor market weakness will continue to dominate price behavior in 2026. Silver sits in a rare position where it benefits from both outcomes. Weak data fuels monetary easing, strong growth sustains industrial demand. The only environment truly hostile to silver would involve strong employment, high inflation, and restrictive policy simultaneously. Current data does not support that combination. Goldman Sachs, analysis of artificial intelligence-driven efficiency and workforce reductions, suggests that employment growth will remain constrained even as output continues. That structural shift favors silver over time. Short-term volatility may be uncomfortable, but it does not alter the longer trajectory. As index rebalancing fades, fundamentals regain control. Today's defense of the $75 level is meaningful. It reflects underlying demand even in the face of mechanical selling. Tomorrow will reveal whether that foundation holds or is briefly tested. At 8:30 a.m., the Bureau of Labor Statistics will release a number that forces markets to choose a direction. Whether silver tests 72 or surges toward 80 depends entirely on that data point. This is not just another report. It sets the tone for the first quarter of 2026. Investors should watch the headline number, monitor yield movements, and ignore emotional noise. The truth will be written in interest rates, and silver will follow.